Hey, good evening, everyone. Marty Missouri here, May 24th, 2022, Tuesday, with a quick stock market snapshot for you. Typically, I'd wait till Wednesday and do a midweek snapshot, but I thought I'd jump in this evening just because today was so volatile and just looking at our end of day charts, thought I'd pop in and kind of tell you what I'm seeing. So, folks, I started this morning's note with looks like the bounce that began intraday on Friday was going to be very short-lived. And that's pretty much true, meaning that today was a down day. However, it didn't end up nearly as down as it was at several points during the day. In fact, the S&P 500 closed down 0.81%. That's not a small drop, but we were down well over 2% for much of the day. I think the Dow actually closed in positive territory. Keep in mind that's only 30 stocks. The NASDAQ still had a miserable day by anybody's standards, and it was down 2.2%. It was down well over 3% at one point. However, the technical picture still says expect more of a bounce right here. Now, as you all know, we believe that the worst is yet to be seen for this market. However, we think that it's very ripe for a noticeable counter trend rally or bear market rally, if you will. And so I wanted to walk you through that and also jump over to the NASDAQ composite. I was looking at the work of a technical analyst yesterday, and he pointed out the oversold nature of the NASDAQ and how unusual that was historically, what it usually portended. And so I created that chart and then ran it back 30 years, and I want to show you what that suggests about where we are right now. So on the S&P, here's your 60-minute, 60-day chart, and here's that area that falls right into that 38% retracement from the rally off of the COVID lows. And we pointed to that, a week or two ago originally as an area of probably some pretty strong buying support. It came off of that Friday. Had a big day yesterday, and at the end of the day yesterday, I really thought we'd get momentum going further into the week. And just after the market closed, I looked at futures and they were rolling back over, and that was right coincident with the news that Snapchat issued guidance lower than what it originally issued. And that just did a number on certainly anything social media, NASDAQ, tech stocks, that sort of thing. Best Buy more or less kind of echoed that sentiment this morning. Then we got new home sales that disappointed and so forth. So just a raft of bad news. And as Nick and I were on our portfolio call in the morning and it was just bleeding, we acknowledged that despite the bleeding, that we wouldn't be surprised if the market didn't rally even out of that today. And that's kind of what happened, although again, being down 81 basis points is not anything to be excited about. And again, keep in mind, folks, we're not looking for sustainable upside out of the present market. We don't think that's the current setup. Happy to go there when the setup tells us to, but that's not our base case at the moment. Our base case is lower but higher first. There's certainly no assurance that it's going to play out that way. I mean, markets are dynamic, and like the news yesterday evening and today, that could throw the market into a tailspin. You could get momentum to the downside, and this notion that we're going to ultimately come back and retest this 4,300, which is what I've kind of proposed, just could be far from reality. Right now, the chart still suggests that at least something higher than this may be in the short-term offing. So on the 60-minute chart, we still have these very bullish divergences. Again, you had the lower low here, and you had the higher lows on these momentum indicators, and that's very much intact currently. So there's nothing about today that blew out this technical setup. On the daily chart, the RSI has this existing bullish divergence. Didn't have it on the MACD. However, when you go from this point to this lower low, you notice I dotted a line in there. That actually is a bullish divergence, on the very short term, the last few days for the S&P. We go and we do the trend line here. It's about perfect. And then you take it from here, right? You would definitely have a bullish falling wedge with those bearish flags inside of it. but you now have these bullish divergences. So I have to tell you, that is a pretty bullish setup. It's not a buy signal for a short-term trader until we break above that downtrend. But if that comes sooner than later, you could get some momentum. So on the daily and the 60-minute chart, we definitely have support for this notion that a snapback, bear market rally that could last a little while is still in the cards. And then on the weekly chart, see if there's anything that's changed here in this look, and there really hasn't. We still have, this, and technically our base case is still 11, off of today, 12% to go from here, falls right in line with the 200-week moving average, and retracing this rally by 50%, okay? Ironically, I also noticed here is that when I run the retracement of the decline that we just had, right, and I go from here to here, ironically, the 50% retracement of the decline is right there at that 4,300 spot. That gives support that would be about perhaps as good as it gets, meaning that if we started to really rally, and I think that's possible, we could break through this resistance right here. You'd probably run into resistance at 4,200, right? So I think the market could run there, chop around there for a while. Maybe that would be it. If it breaks through there, it's going to be very hard to overcome 4,300 to the upside. But that is, it's got to be 7-8% higher from where we are right now. When we go down here and explore the momentum indicators, this is just a very bearish look on the longer term chart. However, there is one signal there that we should pay attention to probably. And that is on the RSI, this green line right here is 30, okay? Below 30, it's considered oversold by technicians. We just touched it here on the S&P 500. Notice here historically, when we just touched it or penetrated it here, this was at the COVID low, and then boom, we came out of it. Just within a hair of it, at the bottom of the 2018 20% decline, right? The 2011 intraday 20% decline, there's the bottom, right? The Great Recession in that big almost 60% blowout in stocks, what we had here was we bounced off of it here, and then we rolled over again, but then we had a real bullish divergence there telling us that according to this, and they had it on the MACD, the worst was probably over back in here in March of 2009. In here back in 2002, the bottom of the bear market, right? 2002, March of 2003, big bumps right when we were oversold. During the tech bubble bursting, these actually percentage-wise, I'll show you on the NASDAQ, are pretty substantial. So again, we think we're in a bear market currently, but we're in an oversold state on the weekly chart within a bear market, and a pretty good pop. Remember, each bar is a week, and a pretty good pop maybe in the offing. So let me just finish up with showing you what I was referring to earlier. And this is the chart I ran last night on the NASDAQ Composite Index. So the NASDAQ, and first I'll zero in and show you the RSI line. So on the NASDAQ, we're actually below, unlike the S&P where we ticked it and bounced off of it. We're definitely below in oversold territory on the weekly NASDAQ chart. So last time we were there was right at the bottom of COVID, and we got a big rally, and we sustained that rally. There's other factors that are telling us this likely isn't sustainable. But when we go back and we test it back to 1995 forward, virtually without exception, when we hit or penetrated that line, we got big pops. So this was during the great tech bubble bursting. This was a 43% bounce that bounced over the course of about a month, right? This was another similar bounce in terms of percentage over the course of about 4 months, right? So these bear market bounces can last a while. The worst bounce was 14% among all of these. When we got oversold, during bear markets, it wasn't the end of the bear market necessarily, right? Other factors would have to get us excited about really piling in here. But at any point where we hit on the weekly, these oversold levels, we got nice bounces, right? 30% bounce out of there. huge bounce out of there. I mean, I stopped at 82% because we had a little correction right in there. So folks, suffice to say, right now, given what I've shown you on the daily S&P chart and on the 60-minute chart and on the weekly here on the NASDAQ, there's still reasons to think that we get a pretty nice relief rally out of this. I'm not giving trading advice. I'm not saying you should be rushing out and trading these things, but I am basically, helping you gauge your short-term expectations. But at the end of the day, I think the most important thing here, at least based on our analysis, is that if we do get a really strong pop, which the technicals are suggesting we might, our base case is that is what I'll call here a bear market rally, and not something that should have us thinking that the worst is over. Now, other developments may occur along the way that change our minds, and of course I'll be reporting to you on that immediately, and you'll see us make adjustments within your portfolio to express that. But right now, we think there's going to be better opportunities in the months to come to put more money to work, could be to put proceeds from our hedge to work and so forth. But in the meantime, it could be something positive in the days and weeks to come. Time will tell. I'll keep you posted. Thank you as always for watching and listening. Talk at you soon. Bye-bye.